Most people believe their credit score improves simply by paying bills on time. It's a comfortable assumption, predictable, easy to follow, and seemingly fair. Yet this common belief traps millions of responsible adults in stagnant credit tiers for years, even decades. You can pay every bill punctually, avoid debt, and still watch your credit score barely move, stuck in the same range between 630 and 680. The misunderstanding lies in equating no late payments with strong credit behavior. Payment history matters, but it's only one part of how credit scoring models actually calculate reliability. The FICO model, used by over 90% of lenders, weighs 5 categories: payment history, 35%, amounts owed, 30%, length of credit history, 15%, new credit, 10%, and credit mix, 10%. Focusing on just one factor, payments, means ignoring 65% of the equation. This imbalance is why even disciplined people see limited progress. Consider a typical case. Someone with a $2,000 credit card balance and a $5,000 limit keeps paying the minimum and never misses a due date. Their utilization ratio is 40%, which signals moderate risk. Even with perfect payment history, the scoring algorithm penalizes them for using too much of their available credit. Result: their score remains average. A second person with the same balance and perfect payments, but an increased credit line of $10,000, drops utilization to 20%. The system reads this as lower risk and rewards it with a score boost of 50 to 70 points. No new spending, no extra payments. This example exposes the central issue. Most people manage debt emotionally, not systematically. They feel safe as long as bills are paid, but credit algorithms measure structural behavior, not intentions. By misunderstanding what the system values, households effectively pay more for everything: mortgages, cars, insurance, even basic services tied to creditworthiness. The financial impact is measurable. A borrower with a 650 credit score might secure a 30-year mortgage at around 6.8%, while a 750 score borrower gets closer to 5.3%. On a $300,000 loan, that 1.5% difference equals over $100,000 in extra interest payments. The ironic part is that the borrower did everything right, never missed a payment, but didn't manage the other variables the scoring system rewards. This pattern repeats across generations. Credit stagnation quietly erodes financial potential, not because of bad habits, but because of incomplete understanding. The system doesn't reward moral discipline, it rewards optimization. Payment consistency protects your score from dropping, but it doesn't push it higher. Real improvement comes from how you manage credit availability, account longevity, and credit diversity, principles most consumers never intentionally plan around. Many people assume improving their score requires more money or faster bill payments. In reality, the shift is conceptual, not financial. Understanding how to present financial behavior to align with scoring logic can generate up to a 100-point improvement, often without a single extra dollar spent. And that's the key misconception this video will dismantle: the belief that you must pay more to earn better credit. The next part will uncover why this misunderstanding persists and how the structure of the credit system itself encourages it. The credit stagnation problem begins with behavior, not income. Most consumers treat credit as a reactive system. They borrow, spend, pay, and repeat, with no structured logic behind their actions. This approach feels natural because it mirrors how personal finance is taught. Avoid late payments, keep debt low, and wait for time to build trust. But the credit system doesn't measure patience, it measures algorithmic risk. The gap between how people behave and how the scoring model evaluates them explains why consistent payment history alone rarely creates significant improvement. Let's break down how the credit model interprets data. Payment history, the category people obsess over, tells lenders whether you're safe. Amounts owed, credit mix, and length of credit history together tell lenders how you use credit strategically. A borrower who utilizes less than 10% of available limits, manages multiple account types, and allows accounts to age signals a lower long-term risk. This is because credit scoring models, especially FICO and VantageScore, are designed to assess risk behavior trends, not moral discipline. The more balanced and predictable your usage, the higher your statistical reliability. Here's a simple scenario. Case A. Sarah, a teacher with stable income, uses one credit card for all purchases and pays it in full every month. Her limit is $3,000, and she often spends $2,000 before clearing it on payday. Each month, the credit bureau records a 65% utilization rate because reporting happens before her payment clears. Her score remains locked around 660. Case B. Anthony earns less than Sarah, but has 3 credit lines totaling $10,000. His monthly usage averages $1,500 spread evenly across accounts. His utilization rate never exceeds 15%, and reports show consistent low-risk behavior. Within 6 months, his score rises to 740. Both individuals spend responsibly, but the system rewards the structure, not the effort. Why does this happen? Because credit models read snapshots, not narratives. They analyze your ratios and account mix at the moment of reporting. If the picture looks balanced, you're considered trustworthy, even if you owe the same amount as someone else. Without deliberate control of timing, limit levels, and account diversity, you can work hard without progress. The system responds only to patterns that suggest risk stability, not moral reliability. This misunderstanding is reinforced by conventional financial advice. Traditional guidance like pay your bills on time or don't borrow more than you earn is technically correct, but incomplete. It keeps you from damaging your score, yet it doesn't teach optimization. Financial institutions have no incentive to explain this nuance because it's in their interest for consumers to remain predictable, not strategically informed. As a result, many households treat staying out of debt as the goal, while lenders use more sophisticated behavioral scoring to assess creditworthiness. Another contributing factor is income structure. People with irregular pay cycles, common among freelancers or small business owners, often have volatile utilization rates. They might pay down balances later in the month, unaware that timing affects reported scores. This instability leads to lower averages, even with responsible habits. Again, effort doesn't translate to results because effort alone isn't what the algorithm measures. In practice, stagnation comes from lack of system awareness, managing money intuitively, not analytically. Without a consistent framework for how and when credit data is reported, consumers cannot control how they appear to lenders. The next part will identify the key mistakes most people repeat for years and how those errors compound into long-term financial costs. When you analyze thousands of credit score patterns, 3 recurring mistakes explain why most people stay below the excellent threshold. These errors have little to do with income. They are behavioral and structural, not financial. Over time, they quietly reduce wealth, opportunity, and long-term stability. Mistake 1: carrying unnecessary debt or high utilization. Many consumers assume carrying a balance helps build credit. In fact, it does the opposite. Credit models view utilization, the ratio of balance to available limit, as a reflection of risk. The ideal zone is below 10%, yet the average American maintains 37 to 45% utilization across revolving accounts. Over 10 years, this discrepancy reduces possible credit score growth by 80 to 100 points. A score of 670 versus 770 may seem minor, but that difference can cost up to $25,000 in additional interest on a $20,000 car loan and over $100,000 on a $300,000 mortgage. The financial cost of misunderstanding utilization exceeds the cost of the purchases themselves. Mistake 2. Closing long-standing accounts. People often close older credit cards they no longer use, believing this makes them simpler or safer. In algorithmic terms, it shortens average credit age and increases total utilization. Losing 10 years of account history might drop your score 30 to 50 points overnight. Over 20 years, that lower tier means consistently higher borrowing costs, reduced loan options, and less favorable insurance rates. A household that refinances twice over that period could spend an additional $40,000 to $60,000 in interest because of this single behavioral choice. Mistake 3. Ignoring account diversity. Most consumers use only one type of credit, usually revolving accounts. Scoring models reward balance between revolving credit cards and installment loans accounts because it signals experience managing different obligations. Someone with a single credit card might remain in the mid-600s indefinitely, even with perfect history. Introducing one small installment account, like a secured personal loan or credit builder loan, can add 20 to 40 points within months. Over 5 years, that small difference compounds into lower borrowing costs on every major purchase. The long-term consequence of these mistakes is cumulative opportunity loss. A household maintaining a 650 to 680 score over 20 years will likely spend 15 to 20% more on interest than a household averaging 750 plus. On a middle-class financial path, a car replaced every 8 years, a mortgage once, education loans twice, that translates into $150,000 to $200,000 in avoidable payments. That sum could instead fund investment capital, retirement savings, or property equity. The issue isn't income level, it's allocation quality. Behaviorally, these errors stem from passive management, assuming that no late payments equals healthy credit. In reality, credit is a dynamic metric that rewards optimization. People with identical earnings and debt-to-income ratios can experience drastically different results depending on how they structure credit usage. Data from the Federal Reserve shows that individuals who maintain utilization below 10% and preserve accounts longer than 7 years have an average score 90 points higher than those who don't, regardless of income. In financial terms, failing to systematize credit management is equivalent to accepting a lifetime of premium pricing. It doesn't cause collapse, it limits potential. The difference between average and excellent credit is not effort, but precision. Understanding what data the system rewards, and structuring decisions accordingly. The next section will move from diagnosis to action, breaking down the exact mechanics behind a sustainable, reliable way to increase your credit score without additional spending or new debt. Improving your credit score by 100 points without spending extra money is a process of system alignment, not financial strain. The credit scoring model rewards predictable, low-risk behavior, so the key is to design your credit structure to showcase those patterns. The method isn't a loophole, it's an adaptation to how algorithms interpret your financial data. The foundation of this system has 4 components: utilization control, credit expansion, authorized credit history, and accuracy management. Each interacts directly with a specific weight in the credit score formula. 1. Utilization control, 30% of the score. The fastest measurable improvement comes from lowering reported utilization below 10%. This doesn't mean paying off all debt instantly. It means managing reporting timing. Credit bureaus typically collect balance data from issuers every 30 days, often a few days before the statement closes. By paying most of your balance 1 week before the statement date, you ensure lower reported usage even if you use the card regularly. Example: if your limit is $5,000 and you reduce your balance to $400 before reporting, your utilization drops to 8%. The system interprets this as low risk, typically adding 40 to 60 points within 60 days. 2. Strategic credit expansion. 10% new credit plus utilization effect. Opening a new line increases available credit and reduces your overall utilization ratio. The key is moderation. One new account every 6 months maintains algorithmic stability. For instance, if you currently have $5,000 total credit and add another $5,000 limit card, your existing $1,500 balance lowers from 30% utilization to 15%. This single structural shift often adds an extra 20 to 30 points. Because the impact of new inquiries fades after 90 days, the net effect over time is positive. 3. Authorized user strategy. Length and mix benefits. Becoming an authorized user on a well-managed, long-standing account leverages another person's credit history without legal risk. Scoring models count authorized accounts toward average age and payment history, adding both stability and longevity to your profile. Suppose the primary card has a 15-year history, 5% utilization, and perfect payments. Your score can gain 30 to 60 points once the account is reported. This method is effective because it strengthens two scoring categories simultaneously: history and utilization. 4. Accuracy and data efficiency, the maintenance phase. Roughly 20 to 25% of credit reports contain inaccuracies, outdated debts, incorrect limits, or duplicate accounts. Reviewing credit reports quarterly ensures data integrity. Correcting a single misreported limit can instantly rebalance utilization and boost scores by 10 to 20 points. Regular monitoring transforms credit maintenance from reactive troubleshooting into a controlled optimization cycle. This system is stable because it works within the structural rules of credit models. It doesn't depend on new spending, refinancing, or temporary hacks. Each step targets metrics the scoring algorithms already use, creating consistent upward pressure over time. More importantly, it is sustainable. Once utilization thresholds, account ages, and data accuracy are established, minimal monthly maintenance, 15 to 30 minutes of review, keeps results intact. In practice, these 4 components can raise a 650 score to roughly 750 within 6 to 9 months under moderate consistency. The result isn't luck or system manipulation, it's alignment, presenting your existing financial behavior in the format the model values most. Stability comes from predictability, not risk-taking. The final part will connect these elements into a long-term structure, a step-by-step system for sustaining strong credit over years and translating credit optimization into real financial advantage. A high credit score is not luck or privilege. It is the outcome of a structured process. The system you apply today defines not only next month's credit report, but the financial leverage you'll have in 1, 5, and 10 years. Long-term credit strength grows from consistent behavior repeated within the algorithm's logic, not from occasional effort. To integrate the previous principles into a working framework, divide your credit optimization plan into 3 progressive phases. Phase 1, Foundation, months 0 to 12. Your goal in the first year is measurable control. Month 1 to 3. Review all credit reports for errors and dispute any inaccuracies. Adjust payment timing so balances are below 10% before the statement date. Month 4 to 6. If utilization remains above 15%, request limit increases or open a small new account to expand available credit. Keep total applications to 1 within this period. Month 7 to 12. Maintain consistent utilization, monitor authorized user account performance, and track score monthly. At this point, scores often rise 80 to 100 points if steps are executed precisely. Phase 2, Stabilization, years 1 to 5. Once the score reaches 740 plus, the focus shifts from growth to stability. Keep old accounts open to preserve average age. Continue using less than 10 to 15% of total credit across all cards. Introduce one new installment account if the credit mix is narrow. Conduct quarterly credit reviews and annual data accuracy checks. By year 5, the reward is tangible. Interest rates on major borrowing, mortgages, vehicles, personal loans are 1 to 1.5% lower. Over a typical financial cycle, this saves around $5,000 to $7,000 per year. The capital not paid in interest compounds as equity, investment, or retirement savings. Credit becomes a financial tool, not an obstacle. Phase 3. Optimization and longevity, years 5 to 10 plus. In the long term, the objective is to transform good credit behavior into financial efficiency. Rotate account utilization evenly across all active lines. Avoid unnecessary closures or multiple new inquiries per year. Reassess credit needs annually and align limits to overall income growth. By maintaining this balance, a credit score not only remains high, but becomes resilient to temporary fluctuations. A single missed payment or inquiry will no longer cause major change because the system reads long-term consistency. Immediate action plan. 1. Check your current credit utilization for each account. 2. Identify statement dates and adjust payment timing accordingly. 3. Review your credit mix and open one small account if you lack diversity. 4. Request a credit limit increase where utilization often exceeds 20%. 5. Set quarterly reminders to review your reports. These actions require no new spending, only scheduling and structure. Within 6 to 12 months, your credit profile begins showing traits of low statistical risk, steady utilization, aged accounts, and stable data. Over 10 years, those patterns compound into lower financing costs, expanded capital access, and higher net worth. The conclusion is straightforward. The credit system rewards structure, not effort. You don't need more income or constant adjustments. You need consistent application of the same measured process. Aligning your behavior with how the model evaluates risk builds lasting financial advantage quietly, without speculation or risk-taking. Once structure replaces habit, stability replaces uncertainty, and strong credit becomes permanent.